Right, everybody, I can see people are still joining, but let's kick off in a timely manner. So on behalf of Sullivan and Worcester, London office, and myself, Geoffrey Wynne, welcome to the first webinar of 2025, entitled Some New Ideas on How You Might Document Your Trade and Trade Finance Transactions in 2025. I thought initially that I would sort of open with what might be regarded as a lighter topic, but I see quite a lot of you are interested in this. And consequently, this is going to be a little bit of a whistle-stop tour through a lot of documentation because trade finance is quite inventive as to what it does. And I'm going to rush through some of the slides, but don't worry, those slides will all be available later. Also, if you want to ask questions, the chat box is open and I can see it. So if you have any questions, unless they are really burning ones, I'll take them at the end. But also, please use the chat to suggest any topics you might like to hear. So what I thought I would do is to just give you some rationale about documentation, my thoughts on that. Then to look at what's going on in legal developments and practice that concerns us, might improve things, the legal environment, the political environment, practical other things. And then to look across the whole of trade finance to see what documentation is available, how one might document, and then with a deeper dive into what is available with some, what I think I hope you'll find some interesting developments that we've particularly been involved with, and then to sort of move into some general points, and then just have some thoughts about how and what we might document in 2025. When I said I was doing this to a fairly senior in-house lawyer, their comment was, well, some of my business colleagues say, well, why document? Because, you know, after all, we could verbally agree whatever we want with our customer, we trust them and nothing will go wrong. And, oh, okay, let's have just a light touch in documentation. But then you get the conflicting, contrasting views. If trade finance is so safe, why is anybody creating any fuss about the documentation? With, of course, the counter on the compliance and regulatory side is, well, trade finance, of course, is inherently risky, if you remember that, so we need protection. And, of course, the answer is somewhere in between. So being serious about what I'm going to be talking about is we need to document the transactions that we work on. And the real question is, well, what documentation should we use? Have we used? Is it still fit for purpose? What should we look at in 2025? And then, of course, well, what is 2025 going to look like? And who knows? There's a lot of speculation, a lot of discussion about the digitalization of trade, some suggestions that the new President Trump, might be bad news for international trade because of sanctions and penalties. He might be very good news for international trade, but I'm not going to get into any of that at all, you'll be pleased to know, because what I want to do is to keep this talk to documentation and our needs in documentation. So what drives the choice of documentation? Well, your internal requirements, whether you are a financial institution on the lending side or indeed on the obligor borrower side. So this use my standard form is a request that might come from internally from you, from your counterparty. The decision, of course, as to what you use will depend on the strength of the various parties, counterparty pressure, internal pressure to do the deal. And of course, where a lot of time has been invested in standard forms, the idea then is to use those standard forms. And the question is, well, do those standard forms flexed in any way to permit a particular transaction? Do they allow departures from the standard? From, if you like, my point of view as external counsel is, how can we help? What guidance, what checklists are there? How can we make it work? And then the issue of, well, what is actually being offered in this particular transaction? And that is the type of facility, and I'll look at that in a moment. The parties who are involved in the transaction, how many parties are involved? What's the product, oil, metal, softs, and so on? What countries are involved? Because all of that is going to dictate, in my view, the approach to documentation. And then there's the spectrum of law and regulation, existing and future. I'll touch on ESG and sustainability just in passing. Remember, I'm looking at it from a documentation point of view. But the question is, what effect is that having on documents as well as transactions? And of course, this moving body of sanctions and equivalent, anti-crime and so on. How do we tie down the moving target in order to make documentation work? So if you like, in the trade finance shop, if I may call it, there's a lot of choice. There are a growing number of templates around for different products. And so can we say one size fits all? Absolutely not, because there are many variables. And what we need to do is to drill down into what those variables might be. And of course, if you like, the key driver is the type of facility. You know, am I lending? Am I borrowing? What are the obligations? Where is my money going? If I'm buying goods, receivables, or whatever. It's always helpful if you're external counsel to have a term sheet. But those are not always prepared, and sometimes people launch straight into that. But a good template term sheet may well be a good starting point because it creates a focus, or at least when you're looking at what the transaction involves for you, is to extract the key points that matter. And then that helps in the guidance of how we might document. Risk analysis is important, and you need to cover all of these: the counterparty risk, the other parties involved in the transaction, as I've said before, where and what is taking place in what country, what other countries are involved, and of course the commodity. And so whoever you are, these are key in documenting. And well, the documentation may not help to get your money back, but certainly bad documentation will help you lose money. And consequently, it is worth looking at documentation. In addition, I headed this regulations, but due diligence. Remember the consideration, because it's fine to talk in trade finance terms about a risk-based approach to the transaction, but that is only worthwhile considering if you've actually looked at the risks on the particular transaction and then worked out what you're doing about it. We're seeing more and more changes to documentation to cover issues like sanctions. How do you cover that? What is the balance? What is the protection? Do you want to destroy an irrevocable payment obligation in a letter of credit by overprotecting? Do you need more? And I'll mention in a little while the unexpected court cases. But equally, as you might not be surprised for me to mention it, unhelpful regulations for banks and going beyond banks, where the regulators fail to understand the importance of trade finance and permitting valuable trade to be done. So do you need more? Well, documentation forever grows, and that is an issue in and of itself. The other aspects, well, For ESG, there are now forms that are being produced by a number of bodies that look at wording to cover ESG. Because I spend quite a lot of time dealing with emerging markets, you would not be surprised that when I look at ESG, I say perhaps for emerging markets, we need less of the E, the environmental, and more of the social and governance. Because it is clear that emerging markets represents a great place for trade finance, is a great need. And the consequence of that is if there is an overemphasis on, if you like, the E and indeed the sustainability, opportunities will be lost to help developing economies. The new US president, with its change, yes, it's becoming very clear that things will change, not necessarily for the better. I was on a webinar a couple of days ago when we were looking at some of the presidential decrees potentially adversely affecting the ability to do business in parts of Latin America, as to whether you might be caught up in problems and whether we can see our way through it. Now let's move into the deeper dive. So what I want to try and do for the next major part of this talk is to break down facilities and what's available into what I thought were sort of bite-sized pieces, so that we can have a look at the various products that we might want to offer and then how we might document. So naturally, I've decided that I ought to start with what one might call the structured trade, but the loan products. So pre-export finance, if you like, as a starting point, but essentially the lending of money primarily on a secured basis and what's available to deal with that. I then want to move on to a space where there have been more developments on bank-to-bank. I call it loan documentation, but actually bank-to-bank documentation, how a bank might bring in another bank, how it might make a facility available to a bank to enable that bank to conduct trade finance. I want to talk in passing about letters of credit, but more importantly about issuance and confirming bank facilities that we might use, and whether recent court cases may require a new approach to that. I'm very interested in seeing developments in inventory finance and whether this is now a growing product, how we might document it and what the problems are. And then sort of to look at what I might also have covered but have failed to do so. I'm not really going to talk much about or anything about export credit. I am going to talk about a little bit on digitalization, but these are best left, I think, for future webinars, and I invite you to say whether you'd like any of this to be covered. So let's move on to lending. Well, Loan Market Association, to its credit, has over the years provided a lot of guidance and a lot of templates. There are some helpful updates, but one of my questions is the extent to which some of this documentation is fit for purpose in a lot of the trade and trade finance deals that we are working on. And the answer, of course, it depends on the purpose of your particular facility as to what you want. But there is no doubt that the guidance and templates coming out of the LMA keeps us on our toes and keeps us well informed. But if you'd like, my question to you as those involved is, what do you mean by I need LMA compliant documentation? Because if I said to you, if you want an LMA compliant document, then most of those documents are in 100+ pages. The LMA pre-export finance document is closer to 200 pages. Is that what you mean, that you want to see lengthy documentation, or is there another way we can interpret that? But let's have a look at that in a moment. I asked my team to have a look at just what was coming out of the LMA just in very recent times. And I'm not going to go into these at all in detail. They're just there for you to look at. But green loans topic, there's some drafting for it, some provisions that you might want to use. I mentioned briefly the pre-export finance template, and that itself has some derivations into some of the emerging market documentation. It's got useful updates to cover things like the demise of LIBOR and the use of term SOFR. Equally, there's LMA guidance on untied ECA financing. If you're not involved in ECA, do you care whether it's tied or untied? But there's a growth of untied. In other words, an ECA financing that is not directly related to the host country's procurement process on that. So you've got some guidance on this and some wording. There's buyer credit documentation, which again, thanks to the LMA, gets updated, but you have issues as to, again, is this a document that you want to use? And a lot of the ECAs themselves are producing their own documents, as indeed are the DFIs involved in this space. I raise this because this announcement came with a glossary of terms only a couple of days ago on that. It has interesting definitions of fund finance, and investments. The LMA say the aim is to promote efficiency in practice and to increase the understanding of fund finance. It's got a list of terms set out, you might say helpfully alphabetically, but in some ways it doesn't get some of the definitions you want. It lists a lot of potential types of financings that funds might use, provides some clarity because it does explain all of those terms, but I might suggest to you that it is complex, it's complicated. And then I ask a mischievous question, does it cut across what others are doing? And in some ways it does. I mean, I, for example, are working with it for the International Trade and Forfeiting Association on their work with non-bank investors in trade finance assets, where we have some definitions, and I've worked on rules of the game, which many of you may know about, where we've tried to simplify how a non-bank might join financings. It could do it by way of a fund, but there are other ways. And I just commend the thinking that it doesn't always have to be that complex. So if that's the case, then what are the alternatives to using the LMA form? Well, we've created shorter versions based on the LMA structure of clauses, but to get, if you like, to a point where we've shortened the document to cover what we see as necessary to reflect what you may be working on in a term sheet or equivalent, and consequently to be more focused on the facility that you're offering in that particular transaction, and then allowing ourselves to add what I call relevant security documents, with, of course, the balancing act of whether the security documents have to be English law or local law. Security documents are important, it seems to me, and there's too much to consider in this discussion. And I'm happy we'll break this up into, again, discussions on security documents. I'm an English lawyer. English law is a prominent law in trade and trade finance. So I start off with this, English law is a good starting point on that. And there are many questions that I am asked and are being asked is, do I have to have local law security? There's a cost and reward benefit. When must I have local law? Do I need it to enforce? Do I need it for protection? on that. Are there ways that I can structure my financing that I don't have to do this? And the answer is possibly. There are alternatives. For example, a magic word that I use a lot of the time to all of you, and that's monitoring. That if you start off in a transaction saying my exit to this transaction will be by enforcing local security, I would suggest, respectfully, of course, that you probably shouldn't be doing that transaction. So the consequence then is, can I build up my documentation with some form of security? Can I monitor? Can I protect? Can I achieve what I need that works for everybody? And we'll come on to that. Let me pause for a moment and then move on to what is an interesting area. We have been working with ITFA for a number of months to create a SWIFT loan. SWIFT loans are very interesting, primarily because they're always written in capital letters because of the SWIFT messaging service. The idea has been to have a short-term template for one-off interbank trade loans. In other words, what you would be doing is you would be providing finance to another bank to enable that bank to finance or refinance an underlying trade transactions, singular or plural. And then depending on your concerns, how much you wanted to know. As of now, it's in its final phases of development. And we hope that ITFA will be able to launch this in the next few weeks as a short form document to evidence primarily a single drawdown, a balanced document that would be acceptable to both the lender and the borrower, with some options and some guidance, with the idea that SWIFT loan lending can be made easier on a one-off basis. And that, I think, hopefully is important. What is interesting in discussions about where the SWIFT loan is used, it's not just used in emerging markets, but is used in some of your domestic markets as well. Taking that, if you like, a stage further, we have also been working with BAFT on an update of the Master Trade Loan Agreement, the MTLA, which many of you may recall was created in 2014. So it's quite a bit out of date. And then the question was, well, why would you use an MTLA? And so bullet point 2 was to cover bank to bank, big bank, small bank lending. So in other words, it's a master trade loan agreement between financial institutions, again, is not a document to be used with commercial borrowers, for example. And it reflects generally an unsecured, unguaranteed, and uncommitted document, which we hope, and certainly the working group hopes, is more appropriate to the current market. And we hope that this will be finalized in the next month or so. It differs from the original document in that this is actually designed to operate as a master, but following, if you like, the BAFT MRPAs, the trade loan request as described operates as an offer and acceptance for each utilization. That makes it very flexible because you have master terms that apply, representations, warranties, events of default, as you wish. You can apply more or disapply per transaction, and those transactions can be between a particular branch or office, or you can add branches or offices on a transaction by transaction basis. So we hope in short-term lending between financial institutions, this will become a document that will be very usable in that lending space. Talking of documentation between banks and financial institutions and more, I just wanted to raise with you the BAF Master Risk Participation Agreements. The current main versions, the 2018 English law and the 2019 New York law, do seem to be getting a lot of use, for which I'm grateful because I held the pen for those. And hopefully we've moved most of you away from the old 2008 English law debtor creditor and the New York law 2009 into an updated document that grants participations in underlying assets, seller, participant. We've done some limited updating to reflect the demise of LIBOR, and it's a useful document. It's a master. It has a concept of master parties, so it allows subsidiaries and affiliates. It's two-way, so you could be seller one day, you could be participant another day, so it is balanced. It has the same offer and acceptance framework that enables you to deal with specific transactions. It covers many products, and going back to 2018, receivables were sort of possible, so there's a separate clause. That has grown, and the type of receivables has grown as well. So the question is, does it need fixing? Or in the vernacular, if it ain't broke, does it need fixing? It's a good base. From what we see, many parties choose to amend them, to amend the masters, or to produce some very specific masters or specific offers and acceptance. Are amendments consistently being made that BAF should look at creating a new version on that? And that's a very good question. And it's something that I and others have been discussing with BAFT, because there are many other options that need to be considered. In others, different products. I mentioned how receivables have grown. There's a lot of promissory notes, and as we move into the digitalization, we may have electronic promissory notes, electronic payment undertakings. Is there more that could be done to the BAF document to cover that, but keeping it two-way? But also, a number of you use one-way, where you are always the seller or always the participant. Sometimes it's the bank, sometimes it's you want to be a participant. You may be a non-bank and you want to be a participant, where you have different views on that. So there are a number of possibilities. And this is a sort of another one of my watch this space, because what is pleasing to note is the framework of the BAF documentation, the granting of an interest in the underlying transaction seems to be very market driven and market acceptable, that we keep talking about it. And so what happens, of course, is that as well as BAFT and the MRPA, there are other possibilities that that may come along. One of these that I thought I would mention is ITFA launched its Master Accounts Receivable Assignment Agreement, the MARA. This template, as described, is a tool to help standardize the distribution of open account assets. Launched for ITFA members in April 2024. It is to be used between banks, as I described in the third bullet point, on a funded basis for recurring supply chain finance and receivable flows, interestingly based on the BAFT documentation, the offer and acceptance idea. So if you like, we're still in play, but we have a document specifically looking at receivables, but looking at two sorts as defined. And I won't waste your time by reading this because you'll get this, but essentially receivable finance, i.e. trade finance receivables, where you're dealing with the seller of receivables, the SCF type product where you're dealing with the buyer and how the buyer deals with it. I'll come on to those in a moment. So the MARA is useful where you are going to enter into transactions with commercial parties to acquire these assets, and you want to distribute them further. This is its use, as described in the guidance notes from IFA itself, where you've got accounts receivables on a regular basis and you want a commitment, you have a commitment and you want a commitment from other parties to join with you. If you're doing a single asset, you probably would not use the MARA, there's the BAF document, or there are other ways of doing it. But so I've talked about how you might distribute this sort of asset, but how do I create this sort of asset? Receivables and payables. Well, as far as I can see, there's no standardization. So there are lots of ways of documenting this. But essentially, there are two main structures. The receivable purchase agreement, where the financer buys a payment obligation of the buyer, and I've used deliberately a neutral term, payment obligation, because that can be an invoice, an approved invoice. It can be an IPU, an irrevocable payment undertaking, or it could, of course, be a promissory note. Bought from the supplier, but taking buyer payment risk with the issue of, has the supplier actually sold to me that receivable, or might this be recharacterized as simply a loan? And there are lots of considerations about that, which include the level of recourse that one has to the supplier, the accounting treatment, and so on. The contrast is the payment structure, buyer-led as described, where there are variations that are with or without supplier involvement. In other words, from a structural point of view, do you need to have purchased the receivable from the supplier when you're actually financing based on a strong payable and payment obligation from the buyer? And that's quite interesting. There's lots of ideas on how you document these, and that's very valuable and very useful to consider how you want to deal with the buyer. Is it a payment services type arrangement? Do you just essentially take the IPU, an irrevocable payment undertaking, promissory note, or whatever? Or do you have to deal with the supplier and onboard the supplier? Should we wait for the digitalization of payment obligations? Absolutely not. But what is interesting is that if we move to that sort of line, that we do get back to where many of us started, which is forfeiting, the discounting of irrevocable payment obligations, i.e. Promissory notes. And we start looking at the sort of forfeiting documents that many of us worked with. Let me pause again. I mentioned that letters of credit. Letters of credit generally, be they documentary, standby, or whatever, warrant at least one talk in itself. What I want to look at here is facilities that you might use as a bank or with your bank to facilitate the issuance or confirmation of letters of credit. And these documents cover terms, times outside of UCP 600 and ISP 98, because those rules, which is what they are, deal very much with the relationship between the various bank parties and the obligation assumed by a party, issuing bank, confirming bank, etc., within a specific letter of credit, rather than the obligation that looks at the parties outside of that letter of credit, the applicant and the beneficiary. What about confirmations? The same. Am I protected as confirming bank by the UCP rules? And the answer is, some say yes, but many say, no, actually, I think I need a better document between the party that asked me to confirm, be it the beneficiary or the issuing bank. If I'm the issuing bank, how do I deal with the applicant? Do I need more protection from the applicant? Because ultimately, who is going to suffer if that letter of credit is not paid, or if the letter of credit is paid, but the applicant turns around and says you should not have paid it, or worse still, it was a fraud or whatever. And there's a lot of structures that we work on within the letter of credit framework. I would just mention in passing structured letters of credit. I'm a supporter of the use of structured letters of credit as a fundraising exercise, with the proviso that careful documentation is required and the parties enter into it knowing exactly what they're doing. But my last bullet point is there's a lot of litigation, recent and historic, involving letters of credit. They are bound to disturb the market, partly because some of them point to frauds being used, but most of them ultimately look to who suffers a loss. And if you look at those cases and then look back at your documents, there is a question, are my documents good enough? Was my letter of credit good enough to deal with the problems that I'm now being confronted with? I'll mention a couple of points in a moment. Last, if you like, big subject, inventory finance, a growing product. Again, no particular standard forms, but if you're sitting there, just think of the main parties. The inventory purchaser, in other words, the party that says to what I call the ultimate buyer, look, I will purchase and store for you goods that you want, that you may take down. Tell me, is there a designated supplier, or do I find the supplier, or doesn't it matter? What are the terms? Am I, as the inventory purchaser, going to store them? Is there an independent third party who's going to store them? So all of these questions need to be asked and answered so that you can deal with all the terms between the various parties on that. Well, it sounds simple enough, and indeed the documentation can be straightforward, but where are the complexities? Well, of course, there are complexities in the rights and obligations that parties assume to each other, but there are accounting and legal considerations. Accounting, the more obligations that the inventory purchaser puts on the ultimate buyer, the less likely it is that the buyer will want to enter into the transaction, because if it's already not getting the benefit of off-balance sheet treatment, how do you deal with it? The legal considerations for the inventory purchaser are, have I actually bought these goods, or have I just acted as agent for the ultimate buyer, and therefore I don't have any rights at all? I've just got debt claims. I think there's more to come on this. I think it's a good product. I think it's a product that needs careful consideration and careful structuring. Now let's move into sort of some more generations. What other documents could we talk about? Well, the good news, if you like, is that many of you on this call are creative in what your structures might be. But of course, you make documentation harder when you come up with creative structures and try and then, if you like, shoe them in to an existing document that you might have. And it's, can you make this work? Equally, as I've mentioned, the whole of digitalization is designed to encourage, in many ways, different structures. As I've said, the electronic promissory note, the electronic bill of exchange, but also electronic documents of title, like the bill of lading, like warehouse receipts, designed, if you like, to make documentation simpler, question mark. But hey, it's all about matching data, isn't it? Well, I don't think so. We'll come on to matching data and electronic records. But the idea, as I've said, of the emergence, or if you like, the re-emergence of these electronic negotiable instruments, electronic because they are now digital when they were in payment for in paper form since in the UK since 1882, that Bills of Exchange Act, and as many of you have heard me say before, a great act, still good law, but unfortunately the drafters had not worked out that you could have a digitalized instrument in 1882, nor did the Carriage of Goods at Sea Act and so on. But electronic documents of title are designed to speed up trade, I agree, but there are new risks and new considerations that we need to deal with. So it's another, if you like, watch this space in relation to what digitalization is going to produce, what the platforms, what fintechs are going to produce. A week or sometimes even a day doesn't go by where I have discussions about the Electronic Trade Documents Act in the UK, about how the model law on electronic transferable records, MELITA, is being rolled out in Europe and across the globe. And as I said to somebody a couple of days ago, remember that MELITA was about electronic transferable records. So essentially, any electronic record needed to be transferred. Doesn't have to be a payment obligation, doesn't have to be a document of title. And so consequently, when you apply it in the UK, we applied it to a specific but not exhaustive list of trade documents. And we looked about exclusive control of an electronic record in a reliable system. Having whetted your appetite, I will move on because there's a lot that we can do and there's still a lot more for us to discuss. We have to document it all, remember. So I start off with, if you like, coming back to my general subjects, let's assume that we do have to produce documentation to deal with our transactions. So the then question is, what standards dictate? Well, what are the standards that I'm being governed by? Are they my internal requirements? Are they legal requirements? Are they what I perceive to be market requirements? And one of the early questions that I invariably get asked is, well, do I need a governing law in this document? You know, I sort of assume that in my facilities, when I write them, that I need a governing law, but I don't need it in a letter of credit, do I? Indeed, if I create a letter of credit in Swift, there's no box that I can select for governing law. Therefore, I assume letters of credit don't have a governing law. Wrong. They all have a governing law, whether you agree it in your documentation or not. How do I know that? Well, the answer is it would get decided. And if you don't do anything else, it will be, in letter of credit terms, the court that decides it. Which court? Well, remember, in your letter of credit, unlike your facility documents, you may not have selected that. So therefore, the first person who gets to court may indeed persuade the court that it enters into that it has jurisdiction. And by the way, that the relationship that it is looking at is governed by that local law, not governed by the law you thought. For example, oh, it's $, it's governed by New York law, it's payable in the UK, it's governed by English law or whatever. I'm a confirming bank and therefore I get the benefit of my law and so on. So the whole issue is that where we can and where it's important, we should determine the governing law of our transactions. And that takes me on to the next point, which is, well, what happens in the unlikely event if it goes wrong? how do you need to handle disputes? Oh, I don't need to worry about that. It won't go wrong. You should consider this. You really need to. My next few slides, I borrowed from one of my litigation partners, and therefore I'm not going to. So some of you may have seen this before. I'm not going to go through these in great detail, but merely to say it would be helpful when we have discussions that you'd actually internally had some analysis as to what this is all about. So what we say is, do I litigate or do I arbitrate? There's no specific test. There are pros and cons. Arbitration, private, control or whatever, easier to enforce because I get asked these questions. There's a New York Convention. You can enforce arbitral awards in member countries over 170 jurisdictions. That may well dictate arbitration. Equally, litigation, I have a bias, as you would expect. English courts, neutral, more suitable for multi-party disputes, better to get quick action. It's in open court. That means that you might persuade your counterparty that he ought to pay rather than have his case heard in public. There are swift actions to get summary judgments, for example, but ultimately you need to weigh this up. And then just a couple of areas to look at. We're going to have a new arbitration act, which we believe will make UK arbitration more accessible and better. There are 6 changes coming through, a revised framework, and we're hoping that in 2025 there will be an arbitration act in place should you choose to arbitrate. We say enhances the attraction of London as a world-leading destination for arbitration of trade, banking, and insurance disputes. There are other places. There's Paris, Singapore, and so on. There are other rules, but just think about: do I want to arbitrate? There's been a lot of legal debate about the UK courts, the Hague Convention. Just note, 1st of July 2025. So post-Brexit, and this discussion on asymmetric clauses, what an awful phrase for you all to consider. If you look at bullet point 2, there was a requirement of finance parties to make obligors submit to the jurisdiction of the English courts, but allow finance parties to bring proceedings elsewhere. There were challenges, there were arguments about that. We could go back to asymmetric jurisdiction, or you might all be happy to stick with exclusive jurisdiction of the English courts. As I say, the summary in relation to this part of my talk is please think about having a governing law, think about having a dispute mechanism, particularly in your facilities, particularly in your master documents, even if I continue to lose the battle on things like letters of credit. There is time to, if you want to ask any questions, if anybody wants to ask any questions, feel free to do so. So my summary: be prepared to document whatever happens. In other words, unless you want to go back to that famous phrase, a verbal contract ain't worth the paper it's written on, we are going to be documenting our transactions in trade finance in 2025. And I remain excited by the possibilities. I read with interest about those who are encouraging trade finance in whatever shape or form it may take. And I think in January, I'm not going to try and guess what we might all be doing. I have some ideas on that and we can debate that. But my point for you in documentation is don't lose sight of the basics And the basics here are the basics as to why and what you are documenting. What's good news, there is plenty of choice in how to document transactions. And I do support templates, both the market-driven ones I'm involved in, and the ones that I'm not. They have their place. In-house templates that we work on have their place. But remember, not every transaction fits a template, doesn't fit necessarily the template that you want to use. And consequently, it is worth looking at transaction to transaction, whether can I adapt the template? Is there something better that I can use? Despite what everybody would like to say, do we go fully digital in 2025? My view, my guess is no way. It will continue to be a mixture, and that what we need to make sure is that the documents that we use in our transactions have the flex to allow for the digitalization, or I think the better phrase, the digitization of some or part of what is going on in relation to our transaction. Many documents that we work with and are working with already allow it. In fact, I had an interesting discussion as to whether you use UCP 600 or whether you use EUCP. EUCP, the electronic version of UCP 600, talks about a fully digital environment. UCP allows both. In fact, EUCP allows both as well. But as I said to somebody, that many of your documents in letters of credit are already digital. Indeed, the letter of credit itself is quite often issued through SWIFT, electronic message. So we are there. We allow electronic signatures. We allow for the production of PDFs. We allow for plenty of digital versions on that, but we'll move on. But I think what I think for 2025 is that I'm hoping it's a good year for trade, expanded trade. It's a good year for trade finance. And consequently, in concluding this, I would say, let's have a good year in our practicing and completion of trade and trade finance transactions. Are there any questions that anybody has? Somebody just asked, can you have a recording of this? Yes, the recording of this plus the slides will be available, I hope, in the early part of next week. Depends how well I spoke as to whether there if there's any delay on that. Are there any other questions? Is there anything else on the chat? And as they see, seeing no questions, seeing no chat, can I ask you to, by all means, let us know, let your contact in the firm know if there are any specific areas you'd like us to consider. The next webinar will be towards the end of February, and then we will be doing our usual running them on pretty much a monthly basis throughout 2025, with some other surprises, I hope, coming for you. I think on that basis, I can happily give you back a couple of minutes. Thank you all for your attendance, and I look forward to catching up with you during the course of the next few days and months. Thank you very much.